The banking crisis 2.0, it looks like commercial real estate and these local community banks are on the chopping block and the guillotine's getting ready to fall. Let's go in and look at the crisis. Let's look at what the Federal Reserve is doing, and then we're going to finish with a market update and what's happening.
So today, right, we're talking about the banking crisis 2.0, a commercial real estate guillotine with the banks on the chopping block. That is a crazy title. Tell me a little bit more about that.
What's happening, I think, right now in real estate is we're really turning into this like tale of two markets where commercial real estate is becoming the problem that it was in 2008, potentially. And residential real estate is on freaking fire, a technical term. And what I mean by that is like, it's two different worlds. They're completely opposite of each other, and they're not moving in the same direction right now. So we all remember what happened to Silicon Valley Bank last year. Well, the answer is buckle up because it's getting spicy again right now. And I'm talking Tapatio, not necessarily Valentina.
Right.
Okay, that's an ongoing debate here. So what happens is, they have these banks, right? And some of these banks are defined as too big to fail. These smaller banks, though, these smaller regional banks, these smaller local banks, they have 80% of this commercial debt that they're holding. So this isn't the JP Morgan Chases, this isn't the Wells Fargo, this is your neighborhood community bank right down the road. And then what we've seen is I want our listeners to really think about like that vacant office building you've driven by, the mall, how there's not tons of people there anymore. And this is thanks to this idea of, remote work from home, and online shopping. So what this is not exactly setting up these lenders for this massive recipe for success. Occupancy rates, especially in office, are at like almost a 20-year low right now, with office being one of the largest parts of commercial real estate. And then once again, these smaller banks holding most of this debt. And we talked about this before, but there's this idea that we're coming to what's called, some are calling the maturity wall. The maturity wall is very simply that commercial debt has a different duration than your residential debt. And that commercial duration is usually like 3, 5, or 7 years. So let's just call it 3 to 7 years. What that means is that commercial debt will reset every 3, 5, or 7 years. Well, 5 years ago, pre-pandemic, office was like the darling. And debt was cheap, so these office buildings were getting super leveraged. And Amazon hadn't killed every mall yet, but they did that during the pandemic. So there's approximately $1.2 trillion in commercial debt that's coming over the next 2 years. And then this one that just made the news is New York Community Bank Corp. So their credit just got downgraded, and it's basically like, when you're a kid and you throw the stone into the lake and you hear the sploosh and it immediately starts sinking. Investors are spooked, and so all regional banks kind of got beat up. But New York Community Bank Corp, they peaked in the last 12 months at $14 a share at the end of July. And as of this morning, it was $4.20. So literally the stock's falling off a cliff. Well, why? This is one of the banks that, as these other banks were going under, it sucked in some of the debt, but some of the debt has actually been worse off than they anticipated. So it's not performing. So they need more money. So they need more reserves. So then their stock's getting hammered. So the government is now looking around, when the first 3 major banks happened, SVB, Silicon Valley Bank, being the first one, which at one point I believe was our 13th largest bank, it got gobbled up. The government, the Federal Reserve, started this bank funding relief program where banks could basically go to the Fed and then give them assets, aka their treasuries, because treasuries were at really low yields. And so if they had to mark them down to today's value, what really would have happened is they would have had to have taken losses.
Yeah.
So they were able to give the treasury these securities in exchange for full face value. The bank funding program goes away March 11th. So all of a sudden, we're getting these banks beat up. We're starting to hit the maturity wall. Debt is starting to come due. Occupancy is lower. And you've got these lease rates and income lower. So let's talk about commercial, like just as one big part of, or like to kind of look at it and how it fits. Commercial real estate is not valued like residential. Commercial real estate specifically is valued on how much income the asset produces. So if the asset produces less income, the value goes down. What affects income? How much debt costs? So a buyer, as the debt rises, is unwilling to pay more for a property. They want to pay less so they can get the same return. So how this crisis is really starting to add up right now is these debts are maturing. These rents or leases are coming due and not being renewed, or they're going to have to be renewed at a lower rate. These banks need more reserves because the Federal Reserve is pinching them right now. And then Jerome Powell. Okay, so he looks at this and he actually said, well, some of the banks are going to have to fail. So they know that this is a problem, and they know this can become a really big problem. When they went to Treasury Secretary Yellen and they said, hey, is this going to snowball into another massive crisis? She kind of poo-pooed it and said, no, it's manageable. But the stock market and other investors right now seem absolutely less convinced because that whole, regional banking sector stocks are getting beat up. So to do some homework today, I called a couple local banks and I had discussions with them. And I said, is your appetite to lend going up or down right now? And what do you think they said?
They said it's going down.
Bingo.
100%. A lot of things are tightening up right now, though, too, right? Like you were bringing up same thing with Jerome Powell, right? Where he was asked the interest rates, right? And there's an election coming up, right? And the interviewer in the 60 Minutes asked point blank, hey, is there an election coming up, right? Does this affect interest rates being cut? Because Jerome Powell said there was going to be a possibility of interest rates being cut.
Yeah.
And straight-faced, Jerome Powell said, no, it does not affect elections whatsoever.
Yeah.
And as you hear that, you realize that's not true.
Yeah.
Like that's a
You're like, no,
lie.
you don't have any political bias.
Yeah. And but going back to this, it's just crazy to see that and to hear Jerome Powell even mention banks having to go through some have fail.
Well, the idea is like, is this crisis going to get out of control and then be, instead of it being the residential banking crisis, it's the commercial banking crisis that then causes the major recession? Because there's trouble in other countries, in Europe and in China. Yeah. Exactly. Evergrande just, they said, hey, by the way, you do have to pay your bills. So this problem is piling up everywhere, and it's going to take more work. When Jerome Powell looked at it again, he said, this feels, and I want to quote it specifically, it feels like a problem we'll be working on for years. This was in that 60 Minutes interview. It's a sizable problem, but a manageable one. And then he goes on to say later on, but it's more likely to affect the smaller and the regional banks. So for our investors, for our builders, our developers, what you need to hear out of this is banking is going to get tighter before it loosens up. So be mentally prepared over the next 6 months for your construction projects, your development projects, to refinance a multifamily, whatever it may be. It's just going to be harder. Now, when things get harder, let's flip this coin over. It also creates massive opportunity to buy.
Yeah.
In that problem is the opportunity. So, and it's happening right in front of us right now. When exactly? Don't know, but realize the opportunity is happening, but the liquidity crunch and the pinch is happening. We told you this was coming. We've been telling you this for a year and a half. It actually took longer than I thought, though. So, you can't be right about everything. Had the right idea, the wrong time horizon. What was next on this list? Oh, that another thing that Jerome was talking about and mentioning here is that the system is going to take losses. So you have to filter everything in Fed speak. So when they're talking about a broad-based thing, and he's talking about commercial real estate, and he says the system is going to take losses. Realize the IMF said that commercial real estate is down over 11%, and sometimes as much as 20 here in the United States. And Goldman Sachs predicted that there could be as large as a 40% drop. So when Jerome comes out and says, hey, by the way, the system could take losses, these aren't little losses. These are million, billion, trillion-dollar losses that the commercial real estate and then, of course, the banking sector is going to take.
So, number 2, what's the Fed's current plan, right? No March rate cuts is what we've heard. They're thinking by May, right, in the 60 Minutes, he was saying there could be a potential rate cut. But for right now, no rate cuts.
I think the Fed is, they're balancing this knife edge. And a knife edge is really thin. And if you move too much, you're just going to slice in half. So they're balancing it. And they're balancing it with, I've got to get inflation under control, and I've got to keep the economy alive. And then what happens is the Titanic is commercial real estate, and it's headed straight towards, the U.S. economy on the knife. And it's like iceberg dead ahead. And you can see these two coming together. They have to talk tough. So the Federal Reserve has to talk tough and come out to prevent all of the moon boys and the moon girls from just betting everything that, they've stopped, everything fine, we beat inflation, to the moon, let's go, stock market, crypto, real estate. The TikTokification is one of the things that's really promoted that, this idea that we're going to go breathe life back into the new GameStop, and we're just going to reignite the market, and everyone's going to bet all at the same time. So their last few speeches and his 60-minute speech were all about talking the market down and calming us down. Also, during the 60-minute speech, he gave us kind of this watered-down version. There wasn't a lot of the usual Fed speak. There wasn't a lot of financial terms. He spoke in very plain English. And the reason for that is there's a difference between the listener who watches the Fed press conference and 60 Minutes primetime television.
Yeah.
So you kind of think about the psychology. So Jerome Powell, as he's sitting down, he's preparing his notes, he's going in, right? He's like, I've got to make this so I don't spook the common man, the common woman. So I don't spook the person sitting there with their wife, eating dinner, watching 60 Minutes. So I thought he was very calm when he did that. As usual, he discussed the importance of this idea of restoring price stability while managing inflation. And there's a risk that they have. So once again, that's that knife that they're sitting on of tightening too much, not tightening enough, or cutting too soon. Because if they cut too soon, what happens is the same thing that happened with Paul Volcker. Paul Volcker, the Fed cut rates too soon, and the embers were still burning in the fire of inflation. And so it reignited, and they had to take rates even higher. What's happened, though, is because inflation has started showing massive cooling, is we have this real simple idea, and that is we're actually moving right now into a more restrictive monetary policy. So it's becoming more restrictive, which says the Fed will be able to cut. So I believe, and a lot of people in the stock market believe, no rate cuts in March. But I also believe that the Fed knows that we have a banking crisis brewing, and their job is to not let that get out of control, because if they let that get out of control, that will take the economy down. One really interesting thing that he said that we hadn't had before that came out of the 60 Minutes, this was my golden nugget that I heard. They want to take interest rates down to around 2%. And so they'll keep the Fed's fund rate at about 2% instead of 0, where they were during the pandemic. If they're at 2 and there's a bump in the economy, the Fed still has a tool.
Yeah, wiggle room.
Wiggle room. Yeah. They can cut, they can go down, they can go up. They can do whatever is necessary to compensate for our economy. Okay? When they're at 0, they can't take them, they can, but then they take them into negative rate territory, which nobody really knows what happens when you go there. I mean, it's the black hole. What's on the other side? Nobody knows.
Yeah.
So, they don't want to do that. And he also said, we don't have to wait until inflation hits 2%. So we do believe the Fed's going to start cutting. We believe we're not going to get all of the cuts that the stock market wants. The stock market wants 6 to 7. The Fed's saying 3. The Fed's saying they're going to cut before, it's inflation hits 2%, and that their job is still not done. They want to restore long-term price stability, but inflation's not dead. What's also really interesting too, we talked about this in the last one, the Fed has not been making references lately to the 3-month and the 6-month average of inflation. And you go, why are you not bringing them up?
Yeah.
Like you brought it up every time before. And then you think about it and you're like, oh, the Moon Boys and the Moon Girls will hear that, because if you look at the 3-month or the 6-month average, we're below 2. But the way we measure inflation is such a long-term, slow-moving 12-month thing that right now it is, but they don't want people to go start spending money, betting a bunch on the economy, because that could reignite inflation.
Yeah.
And if they move too late, it could weigh too hard on the economy and labor. So hearing this is what I think as a real estate person. Depending on what you're doing, right now is probably go time before the Fed drops rates. It's probably that opportunity for the investor to find a good deal, for the buyer to find a good deal before the Fed drops rates. Because what have you personally seen in buyer activity over the last 30 days? Is it up or down?
Up like crazy. We're hearing, the funny thing is, typically we get slow months during January, February.
Yeah.
Right? And right now it starts to pick up around towards the end of February to early March.
Yeah.
It's crazy. We did 3 times the deals that we did last year. So there's this pent up demand from buyers that are seeing it, and they're getting this good news, and there's still this crazy low inventory, right? Which is the craziest part. But buyers are still needing to buy a home, and with this low inventory, and thoughts or people talking about interest rates being cut down has already pushed up the demand. So now imagine once interest rates come down, like you're mentioning, it's just going to be crazy. It's going to be a bloodbath. Because
inventory is still really low, is
Exactly.
the moral of the story. So one interesting fact I want to point out that he also said is he said we need more good data. But then he kind of caveated it, and he said, but it doesn't have to be as good as the data before. In other words, they know they're getting there, and they're just simply trying to buy time. They're trying to buy time before they cut so inflation doesn't reignite. But then that Titanic of commercial real estate, iceberg dead ahead, is just cruising right at us right now.
Yeah.
So the Fed is literally playing chicken with the commercial real estate market right in front of our eyes. Oh, wow. This part, I know this hurts consumers. And this was interesting to hear the Fed admit this on 60 Minutes. So the reporter looks over, and in brilliant fashion, he says to Jerome Powell, will prices decline? And Jerome Powell says, some prices will decline, others will go up, but we don't expect to see a decline in overall price level. That doesn't tend to happen in economies except in very negative circumstances. Jerome Powell literally just told the whole public on primetime news, by the way, prices aren't going down, suck it up.
Yeah.
The next thing he said, and he said this a little while later, was he came back and said, I understand that people feel dissatisfied because prices are up, but the economy is performing well. Yeah, no crap. When the American consumer, me, you, everyone is feeling pinched and prices are more expensive and we have to spend more of our money, on gas and groceries and insurance and rent and, whatever it may be. And our dollars go less, they don't go as far.
It hurts.
It hurts.
It hurts us.
And he just was like, prices aren't coming back down. We'd have to go into very negative circumstances, aka major recession, for that to happen. So the thing that the consumer needs to hear is prices are not coming down, people. And to use the cliche it's been beat into us, this is the new normal in regards to pricing. The likelihood of another real estate banking crisis is low because these larger banks have awesome balance sheets. And then these small regional banks are being worked with to prevent these failures. But the Fed did say, hey, we need to improve our supervision of them. We have to check on our regulation of them. And some of them will fail and will be gobbled up. They just talk about it like it's a fact. It's a foregone conclusion. We're going to lose some banks and that we're going to have some systematic losses in the commercial real estate sector. Right. And once again, you kind of think about commercial real estate, like how expensive a piece of commercial real estate is. If a piece of commercial real estate drops 10%, it's generally speaking, that's $100,000. That could be a few $100,000. It could be millions of dollars. The Fed chairman, and he's not political, so he says something like, we don't advise on fiscal policy. That's Congress's idea. And so the reporter pokes him again. And he says, well, I am concerned about the unsustainable national debt. And then he emphasized that at some point, we won't be able to sustain it. We're on an unsustainable path, and we must change it before then. So without being political, like we were kind of talking about before, he was like, okay, Congress, you're a bunch of drunken sailors. Let's get our spending under control. We're on an unsustainable path right now. Him being a banker and the head of the Federal Reserve, he can see that. Thoughts, ideas?
My question, let's say, for the consumer or for the investor trying to buy, a commercial property, because, there's opportunity, like we were mentioning. Somebody may have a property that is being, what is the word? They're being squeezed.
Yeah.
Right. So then
they're on the verge of distress.
So what, I guess, for the person trying to buy a commercial property, because there's always, to the downside, there's a big upside.
Yes.
What would there be their steps to buying a commercial property like that maybe needs somebody to come in and like buy this for them?
Yeah. So let's just say, one thing that's happening in commercial real estate right now is cash in refinances. See, as investors and as owners of real estate, we only like cash out refinancing. That's when you do the refinance, they hand you money. Now the bank is saying, hey, by the way, your asset's worth less. We want more collateral. So you've got to put cash into the system. I was talking to a young gentleman who has been in commercial lending for a couple years. So this is not a huge lender by any means, but he did work for one of the larger firms. And he's been doing it for 2 years. And I said, hey, are you doing any cash in refinances right now? He said, yes. I'm currently pulling in $10 million in cash in refinances. I said, across how many projects? He goes, 14. I said, so just so I understand this correctly, what you're telling me is 14 different properties need a total of $10 million in order to keep their property. Yes, that's absolutely correct, Anton. So those people had the assets. They're working with the lender. They're going to get the higher rate. Their cash flow is going to go down. They're throwing money into it to keep the deal alive. You need to go find the person who doesn't have the cash, who then has to make the fire sale. And then maybe you buy it with cash, or maybe you buy it as a group of investors, and then realize, because the bank is pinching everyone right now, that you're going to have to buy it at a lower loan to value than you normally would, because the banks don't want to take the risk. So it's going to require a little more work out of you and a little more effort. And then, you should be cautiously optimistic, get more reserves than normal, put down a little more money than normal. But if you find something and it's a good deal, absolutely buy it. Okay. Now, I don't know if I'd go buy an office building in Redmond near Microsoft or downtown Seattle. I would avoid those. That doesn't look like even a safe bet. But let's say there was a strip mall, small strip mall, and it needed a little bit of money, or a medium-sized multifamily. I'm not talking a 200 unit. I'm talking a 40 unit where it's manageable and you've got ample reserve sitting on the side. Cool. Let's bet. It's go time. Notice I said the word bet.
Yep.
In times like this, as you're making an investment, your goal is to minimize your risk and the downsides while maximizing the return. But you don't want to just maximize your return without trying to mitigate the risk. Never take a risk that would sink the whole ship. If this risk leads to ruin, like you don't own a home anymore and you're out in the street, don't take it. But if you could lose this and still sleep fine at night, yeah, take it. Okay, this is a great time to bet.
I love it. Market update. What's going on with the market, moving forward into 2024?
Here in the Seattle Metro, the market is on stupid fire. Stupid fire is a technical term. And what it means is it's stupid next to a fire. So
the worst.
So
that's awesome.
If you ever, like me as a young adult, drank near a very large bonfire and people were stumbling around next to it and someone may or may not have thrown flammable liquid, that's stupid fire. And it's being stupid near the fire. Yeah. It's all the same. But the idea, real simple, is this. Is like the market was deader than a doornail, and then interest rates dropped. And as interest rates dropped, that spurred that buyer activity. And as the Fed stopped raising interest rates, it spurred that buyer activity. It gave that buyer confidence. Inventory throughout the whole Seattle Metro went down. Sales went up. Appreciation throughout the whole metro has already started. Depending on where you're looking, you were seeing January versus January between 4 to 7% appreciation month over month. Now, that's not a trend, but when January starts and it's going and it's like getting ready to take off, that it's the start of a good trend. So I pulled Monday morning on 2/5 the NWMLS stat right off of, they have this little cheat thing that we can look at called Market Watch. And the NWMLS covers 80% of Washington State. So in the last 7 days from February 5th, there was 1,203 new listings and 1,843 went pending in that 7-day time period. Wow. That's the exact example of on stupid fire.
Yeah.
So as inventory came on, more inventory left the market. So inventory is leaving the market faster than it's coming on. Generally speaking, as you leave the winter heading in towards spring, inventory rises a little bit because the weather gets nicer and more people list their home. But because of this pent-up demand. So 1, the spring market is showing up early. 2, there is pent-up demand sitting on the sidelines that wants to buy real estate. And it's not just homes. It's homes, it's condos, it's land, it's investment properties. It's good commercial and small commercial. What was also interesting during that same time period, 563 reduced their price.
Wow.
And you go, wait a second, the market's really hot. Why'd they have to reduce their price? They were overpriced to begin with.
Yep.
And the market constantly rejects this notion of, so you'll hear the seller say something like this, well, I want to price it high, so I've got room to negotiate. Throughout the Seattle Metro, everything sells within less than 2% of the list price. So if you're simply 5% above market value, you don't sell even in this hot of a market that's on stupid fire. So it looks like the market will continue to heat up throughout 2024. We know the Federal Reserve is going to lower interest rates this year. And as interest rates come down, the amount a buyer qualifies goes up, which will increase demand throughout the year. The rule of thumb is every 1% change in interest rates allows a buyer to qualify for 10% more. I hate saying this, I expect 6 to 8% appreciation. And if rates come down a bunch, you could see 10.
Jeez.
The reason I say I don't like that, I am a very long-term vision type of person. I'm a futurist and I'm a maximizer of assets and opportunities. I will take slow, consistent, long-term sustainable growth versus high ups like this. And then the next thing, someone's going to put this in the comments, but Anton, the market's going to crash. No one can afford this. Blah, 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 blah. It's supply and demand.
Yep.
It's as simple economics. We, here throughout the Seattle Metro, we have not built enough homes to keep up with supply. Throughout most of the United States, we have not built enough homes to keep up with supply. 2024 will be better than 2023 in sales. Expect to see 10 to maybe as much as 15% more transactions happen this year. There's going to be bidding wars around anything that's around the median price in the area. So if the median price, in Snohomish County, for example, is, 741,000. So anything that's basically 900 and below is probably going to get a bidding war. Now, if I go up to 2 million, unless it's in a really hot area, that won't necessarily have a bidding war. But we've been seeing bidding wars on everything that's priced correctly. Expect rents to be very flat this year. We've even seen some rents go down. There's some numbers that's been showing that nationally rents have gone down between 2 to 4%. I would say we really felt that here in the Seattle Metro. I'm saying rents are going to be flat because I think later on this year, it's going to go down for the first few months, and then at the end of the latter part of the year, it's going to go up as that kind of rent supply and demand starts balancing. Expect rent appreciation in 2025, 2026. Expect a natural slowdown to happen around the presidential election. It doesn't matter to me if you're Democrat. It doesn't matter to me if you're Republican, independent, libertarian, pink fluffy unicorn party. This is just a fact. A presidential election causes uncertainty. And when FUD, fear, uncertainty, and doubt show up, the consumer simply slows down and holds back. So later on this year, the market will become a wild card for sellers. So if you're thinking, I want to wait, I want to bet now and go now while I know exactly what's happening and while the getting's good, because later this year, and traditionally speaking around presidential elections, the market slows down because of that, both on the buy side and the sell side. PS investors, that also may be a great opportunity to purchase.
Great deal.
Great deals. I did get a text from a good friend last night. It was like, I am listening. I will be in a position by third quarter this year. I will be ready.
That's awesome.
And I was like, is your cash ready? He goes, it will be. And things are getting rented and this is getting done. So we'll be ready to rock and roll. I said, let's go.
That's awesome.
All of the above is going to create opportunities for deals. That's the whole thing. It doesn't matter if the market's up, down, or sideways. There's always an opportunity. And the massive opportunity here in the Seattle Metro is going to be in these areas: land development, new construction specifically, single family, townhome, and dadus.
I like that. Can you talk? There's two questions that I got there. The first one is, everybody's talking about foreclosures, right? Everybody's freaking out. They're like, I'm waiting for a foreclosure deal, right? I'm going to get this great deal. Tell me what's going on with that, right? Where are there going to be a big thing of foreclosures really happening? like people are saying, just all this stuff.
Where is the foreclosure rate right now in the state of Washington? Where's the foreclosure rate at nationally? It's at an unbelievable low. There is no tsunami of foreclosures coming. I honestly kind of wish there was. We sell properties for banks, and it gets investors good deals. 2008 is not happening. You missed it. Oh well. Find a new way to make money. What these banks are doing and what they learned during the great financial crisis and then also during the pandemic is they learned really well the punt maneuver in football. The team is backed into a corner. They don't like the ball over there. They pick up the ball, they punt it. It goes really high in the air, floats for a long period of time, but it's all the way down the field so they can deal with it later. That's what banks are doing right now. We also call it the extend and pretend. We're just going to extend your loan and pretend. How do we know this is happening? Go to the FHA website, look up their delinquency rate, and then look up their foreclosure rate. Their delinquency rate is much higher than their foreclosure rate. So they're actually not foreclosing. Are these banks foreclosing? No. Are there more foreclosures than there previously was? Yes. But you have to realize we hit like a 30 or a 40-year low in foreclosures. So when you're at the bottom, you have to come up a little bit. We're not even back yet to the historical average of foreclosures. So people saying foreclosures are rising, they're rising, but they're not even back to normal. And the banks aren't even going to let it get to normal, number one. Number two, what happened to appreciation over the last few years?
Gone up.
Like a little?
Crazy.
Bing, there we go.
Stupid crazy.
Stupid crazy. Technical term. So basically, people's equity and appreciation shot up like a rocket. Every foreclosure that we've talked to, that our team has talked to, what do they have?
Equity. Crazy amounts of equity.
So if they're behind, all they have to do is sell it. Also, I can't remember if you were in the room when that happened. Did you hear what Ricky said about kind of the mindset of the people he did talk to that are going into foreclosure? What'd they say?
They just say, I'll deal with it later. I can do this. It's fine. We're working on it.
Bingo. I was here in the great financial crisis. All I did was bank-owned properties, foreclosures, short sales, and things like that. They didn't say we're working on it. We can fix it. We have equity. We have a way out. No, they called them jingle keys because they would throw the keys in an envelope because there was no hope, no way out, no bank talking to you, and they would mail the keys back to the bank, and they just walk out. So the consumer, the homeowner today knows they have options and knows that they can solve this. They don't feel as threatened as they did before, and the economy is still really good. So maybe they hit a rough spot. They're just going to go get a new job, work somewhere else. And then that one guy that he was talking to said, "Oh yeah, this has happened. This is the third time. I'll just get caught up again." And you're thinking in your mind, like, how could that hurts my
scary. That's so scary.
That hurts my intestines thinking about it.
Yeah. Some people are just like that.
Some people they're better built for that. Yeah. But the consumer believes they will solve this problem. And in the data, there's no massive amount of them coming. So it's not an issue. Now, can you get a foreclosure? Yes. Are you going to get a smoking deal? No. And I'm sorry to say that. Here's why. If you go to the courthouse steps and you go to buy one there with cash, what type of investors, because remember, inventory is so stupid low right now. What type of investors would you be competing with? Are you competing with like the Finding Nemo, cute little fish investor, or are you competing with the sharks and the piranhas that have gigantic bags of money?
Sharks and piranhas.
Sharks and piranhas, and they have grenade launchers. No, I'm serious. Like the investors that are out hunting right now have money. They know what they're doing. The foreclosure market and that market is not a market to, oh, I'm a first-time home buyer. I'm just going to go hop into it. We listed a foreclosure this week. It's priced well. We've had hundreds of inquiries on it. It's going to be a bidding war. And unfortunately, this bank has made it horrible. It's a very hard process to get to see it. They have to sign a whole bunch of release forms. The method of getting the key is hard. It's just difficult. But at the end of the day, I actually believe, because activity is so high and inventory is so low, they're going to get a very high performance out of that asset. Now, are they going to get full market value? Probably. They might even get better. So it's not the deal. Where could someone find a deal, though? Like if they really, like I have to get a deal.
Off market.
Bingo.
100%.
They got to find someone like Elias who's willing to go hunt an off-market deal. P.S. Our whole team hunts off-market deals.
Yep.
We sell properties on market, off market. In order to get a deal, you got to go buy one off the market. It's just that simple. I talked to one of our investors earlier today, and he said, hey, I'm thinking about XYZ. They're in Everett. And I said, cool. How are we going to pay for it? He goes, cash. I said, cool. Let's make them a low ball offer. Tell them we'll look at it for 2 days and we'll close it in 10. If somebody gets an offer like that and it's not on the market, it's got a 2-day inspection, 10-day close. If they are like super motivated and for some reason or another in life, they've got to take that type of an offer, they're going to take it.
Yep.
Okay. But on the market, you're generally going to pay a retail price. If you want a wholesale price, well, then we got to go hunting. P.S. You also have to be prepared for the mental anguish and the property to not be in perfect condition and things like that if we're going to hunt off the market.
But I mean, even going to that deal that we got for you as the investor,
Yeah.
right? The Everett property,
Yeah.
we were able to get a smoking deal with that one, right? And then this goes to my next question with additional dwelling units.
Yeah.
How has that improved the game in investing? Like I know that it's obviously a great opportunity for built-in equity, but tell me a little bit more about how it's changed so much.
It's
right?
changing
We talk
massively.
about it all the time, but it's like,
Yes. So we've gone over this multiple times, and we just had David Toyer on one of the other podcasts to talk specifically about Washington State's ADU DADU bill. But the bill is simple, and it's been adopted by a couple jurisdictions already, and this is a statewide bill, so it's going to be coming out everywhere. And it'll be adopted by everyone by mid to late 2025. The idea is simple. One, go figure out whether the jurisdiction, the city or the county, has already adopted the code. Two, look into their long-term planning as to when they will adopt it. Then when you know when they adopt it, now you can go create opportunity. So for example, like the one we bought in Everett, we'll just use that one as the example. Everett already adopted that specific set of code. So all we have to do is pick out the right size property with the water and sewer in the right location and at the right depth, has good access, hopefully alley access, has a certain size lot, and then really you could pay market value because you're essentially getting the land for free for your ADU. So whether you're the small investor or the gigantic investor, this play works. Or you're the homeowner who wants to house hack, this play works. You chat with someone like Elias who knows this, or me, or someone on the team, and we find one of these deals that works. You go in, and let's just say they're house hacking it. They go in, they buy it FHA 3.5% down or conventional 5% down, live in it, save some pennies, go get the permit for the structure in the back, save some pennies, build the structure in the back, boom, hundreds of thousands of dollars in built-in equity. Or let's say they don't have the ability to do that. Buy it, call mom, dad, dear Aunt Tilly. Dear Aunt Tilly, can I borrow a little bit of money? Borrow the money, go get the permit, get the thing permitted, and then turn around and sell it and make money as a project ready to go. Because we're getting ready to list one of these projects ready to go. That's one of ours. Why? Well, we got too many projects. So you can't finish them all. They're going to go out to the market. So no, that's a phenomenal opportunity all up and down the I-5 corridor. Generally speaking, it's going to work best in your densely populated areas with alley access, close utilities, and flat lots. Perfect. If you'd like to know more, just call us, text us, send us a message. We'll help you find one. And we have a bunch of them right now anyway.
What should investors do in this market?
I think investors in this market should be trying to figure out, how do I build or create inventory? If supply is low everywhere in the United States, what does that tell you? It says that we need multifamily, single family, townhomes, and we need them built. So if you can figure out how to build supply, that's going to be the best thing, which could include flipping, which could include installing a manufactured home. Just creating housing stock is going to be one of your best opportunities. I think one of your second best opportunities is going to be finding a distressed seller. They are going into foreclosure. Their commercial note is coming due. A distressed seller that needs something, and you're not going to find that on the market. You're going to have to go off the market, and that's going to take time. And you're going to have to spend time hunting for a deal. If you're not willing to spend the time, then you need to give the money to some investor who's willing to spend the time or partner with them. But you can't just expect, when the market's on stupid fire, to open the MLS and just magically find a good deal. Because the market is so hot, and we threw a couple of our things out there to a couple people that, hey, we may sell a project or two. I got 18 text messages, 6 DMs on Facebook, by people I didn't know, 3 by people I did, and 63 comments on just one little thing I threw out there that's something that we own. Sold in 24 hours. Full price. Never even got to the market, just because I kind of casually mentioned that we were thinking about getting rid of it. Got called again this morning by 2 people. Hey, I heard. I was like, oh, you're too late. So that demand for the housing stock, for building lots, for building permits, for subdivisions is very high right now. Everyone wants that. Also, and I've mentioned this before, but it's worth really reiterating, cap rates are still rising, but we know the Federal Reserve has stopped raising interest rates. So we know that interest rates over the course of this year are going to slowly float down. So you've got this unique opportunity to buy commercial real estate at a discount and then refinance at a lower rate later to just improve your overall yield or the performance of the investment. That's going to happen most of this year. Don't be stupid, because commercial is expensive, but there's opportunities and you should be out there looking for them right now. Those are the 3 biggest ones I see. None of this is specific financial advice to anyone. Like, for us to give you specific advice, like, we have to come in, we got to know what you're good at. We got to know what you're looking for. We've got to have a dialogue. We also have to have that part of that dialogue that figures out, what's your risk tolerance? What are you willing to do and what are you not willing to do? Are you willing to go over the property because the tenant that was going to be evicted unfortunately passed away? Bust open the door, double check to make sure there's no tweakers inside, because the daughter called you and said tweakers are trying to break in to it, even though this person was going to get evicted, and drugs are just horrible and this is tragic. But do the hard work. And then talk to the neighbors about the problem that was there. And then containers are being dropped there today to clean it up, to throw everything away, to get rid of the riffraff, to bring the property back. If you don't have that level of risk tolerance, then you may not get that level of return.
That's good.
But if you do, and you're willing to clean it up and deal with the eviction and deal with the problem and deal with the 3 cars and the 2 RVs in the driveway, and, and the fact that, the house was essentially at one point just full of tweakers. Tyler goes, hey, the window back here is broken. Ah, crap. So walk around, window's broken, and there's this door upstairs that was like a door attached, but for some reason it's just like semi-screwed to the house. And so I was like, hey, just put the door over the window, and he literally unscrewed it from the house. We have no idea. Like the little hinges were just stuck to like a post on the deck.
Yeah.
So it was a door that opened to nothing. No door frame, no nothing.
Yeah.
So we unscrew it from the deck, take it around to the backside of the house because someone had just tried to break into the window, and screwed it over the window. And then brought in the big sheets of plywood and screwed it over all the doors just to prevent people from breaking in. Because we got to get the property cleaned up. And once it's cleaned up and all the junk is gone, then it'll be fine. But are you willing to take that level of risk and deal with an eviction and then deal with all the problems?
If not, you can find somebody that does.
You can find someone that does. Or you can buy a turnkey, set it and forget it investment. I mean, that's a perfectly good investment strategy. If I'm making good money and I just want to put money into real estate, cool, let's go buy an A-class property in an A-class neighborhood that's in primo condition. And that doesn't matter if it's commercial or residential or a multifamily. You go buy an awesome asset, it's just performing, it's just throw some money at it and just forget it.
Nice.
Everything from a single family house to a big multifamily.